you. Welcome and thank you all for joining us this afternoon for the Funding Strategies Capital Raising webinar. My name's Ken Freer and I'm joined by our Managing Director, Dr. Mark Rainbird. So I'm going to take you through the first part of the presentation, which is about us, funding strategies, and our sister company, Bluemount Capital, but specifically around the services that Funding Strategy offer. And then I'll hand over to Mark to go through capital raising, so the ins and outs of capital raising. So without further ado, let's talk about funding strategies. So we specialise in venture capital, venture debt, working capital, providing investor-ready services for companies, and then investor distribution. We're a national firm, but our office is in Brisbane, and we're in a partnership with Bluemount Capital. Bluemount Capital does investment banking, corporate advisory, equity debt, listings, mergers and acquisitions, and it's part of a national group with offices in Perth, Sydney, Brisbane, Melbourne. And we're also members of the Orion International Advisors, which is a global network of leading investment bankers that we work together with around the globe. As I said, we're a national firm. We were founded in 2012. We're serving predominantly sophisticated investors, emerging and growing private companies, and we deliver a broad range of services, corporate advisory, strategy execution, leadership, etc., investor ready, as I've talked about, equity and capital raising. So we're typically in that $500,000 to $3 million region. We do investor distribution, venture capital, help with business exits, provide advisory board services, and obviously then through our deal list provide opportunities for investors. We have a team of senior executives that have deep expertise across a broad range of industries. In terms of the benefits of working for us, so our focus is delivering for you. We have had over 100 clients in the past 11 years and helped those companies on their journey. As I mentioned, we're a very experienced team. We've got proven processes and deep industry knowledge. And so we help companies with their funding strategy and positioning the company appropriately. Importantly, we've raised millions of dollars. So we've had successful outcomes for private companies and investors. And we're connected and connect you to a very broad range of capital and funding options. And so in doing so, we provide strategy and the funding options, then we coordinate and run the agreed funding process and do the deal making. So this just gives us, I guess, a full picture of what we offer. And I won't go through this in a huge amount of detail, but I've talked around the corporate advice that we provide. That also includes structuring and financial modelling and creating roadmaps. We do commercial and corporate debt, raising equity capital, which we'll talk more about, mergers and acquisitions on either the buy side or the sell side. And we work across and have experience in a broad range of technology industry sectors, software, healthcare, energy, resources, mining services, manufacturing, fast-moving consumer goods, food, agri, financial services, etc. And then we have investor opportunities, and we have a very strong partner network. So on that note, I'll now hand over to Mark, who'll take us through the capital raising.
Yeah, thanks, Mark.
Ken.
Yeah, so obviously from our side, the first question is, why would you raise capital? So normally the first use of capital is generally to hire people, generally for, say, human capital. So it might be for expansion. In the current situation, we're seeing a bit more, or a few more companies looking at restructuring their balance sheet. And we've been doing quite a lot of acquisitions recently, so people are looking to raise capital to acquire other businesses. But you can see by the list there that the range of options is quite large, and then it sort of gets back to what are the best options to move forward, whether it's equity or debt. And in this case, we're going to focus on equity raising. Let's go to the next one. So as part of providing options, one of the things we want to do is try and place the company on its journey, and and you need to understand where you are in that journey. So we're basically putting options together, and they will vary because we've got different investors and different types of investors. And so you might be at the early stage growth stage, or you might be in the sort of expansion stage where you might be looking to exit to a trade sale over time, or you might even want to go through and do an IPO, initial public offering on the stock market, or do a reverse takeover, which is what we call a backdoor listing. So there's a range of options in terms of the journey that the company is going to go on, and that's important. If we're bringing investors, we need to know how they're going to get back out of the business, and so we need an opportunity for them to exit, in some reasonable time frame. So it might be 3 to 5 years, for example, and that might be earlier if you're a larger growth company. And one of the reasons we called funding strategies is that we're trying to match a funding strategy to the business strategy that the business has, and quite often people don't have a funding strategy.
Okay, I should have said at the outset, we're quite happy for this to be reasonably interactive. So if you've got some questions along the way, then just come through in the chat box, and we'll answer those. So on that note, we've got up there providing funding options and working together. So Mark, can you elaborate on the importance of working together?
Yeah. So in terms of capital raising, as we move forward, we're learning more about the business itself, and obviously the business has the expertise around the business. We have strong domain knowledge, around different businesses and business models. But essentially it's a team effort. So we need a spokesperson from the company to interact with our investors. We have the relationship with the investors, but over time we're handing that relationship over to the company. And so we've got to have good teamwork between us and the issuer, as we call them, so that we can execute the strategy and do the deal making, if you like. Just a note on capital raising. So many will be aware that it's governed by the Corporations Act in Australia. So it's a criminal offence. And I've just got a note there about Astra Resources. So that's on the ASIC website. So if you want to see what actions ASIC's taking, you can just see their website. But essentially, equity capital raising in Australia is, you can divide it into two groups. One is under non-disclosure, as we call it, where you cannot advertise to the public, and the other is where you can advertise to the public. So typically, if you're doing an IPO, you would have a prospectus, which is the right-hand box down the bottom, and you can advertise to the public, and that's all legal, and you can raise as much money as you like. There's other instruments like an offer information statement where you can only raise 10 million. So that right-hand box, for example, you have to have audited accounts, and it's quite expensive, or more expensive, to raise capital. There's crowdfunding legislation where you can raise from retail investors, but there's limits on that, which is the box next to it. In the non-disclosure area, we're mainly raising under what's called an excluded offer, so we can raise any amount, but we have to go to sophisticated investors only. And then there is a personal offer by the company, which is the other ways you can raise.
So then the consequences, if you do it wrong, are quite serious then.
Yeah, so it's a bit like speeding. If you don't get caught, you're not caught. But if you are caught, there's pretty grave consequences. So generally, what will happen is ASIC, if they deem it necessary, they'll take action. So it's normally banning people as a director. You'll normally they can freeze bank accounts, and they can basically take court action against you. And because it's criminal, then there's obviously jail type penalties in terms of the action they can take. So in terms of this next slide just goes through the process. So we always say that the process helps raise the capital. And so we have a structured, gated process in terms of how to raise capital. And so that's very useful. So the first part is understanding information from the company. So we normally get a capital raising form. From that, we have an internal Shark Tank meeting, if you like, and we screen the opportunities. And then from our side, if we think it's something we would like to pursue, then obviously we get mandated by the client, and then we move forward in terms of the capital raising process, which essentially means that we need to get the company investor ready. And so we will have already formed a view of that prior to the assignment. And then that's generally putting a share capital structure together, financial models, forecast, putting a teaser document and maybe a bit of a data room together. Part of that is also putting together a valuation that everyone agrees with, and then taking that to market. So in terms of taking it to market, we then use our investor distribution. So we've got large investor distribution, and that's usually via email or electronic communication. And we also build a strategic investor list that we're going to take it to. And then importantly, we also have a chat about where not to take it. Sometimes these matters can be a little bit sensitive. And then essentially, as we move forward, more typically around standard matters, people fill in a share application form. We need to do the anti-money laundering and identity check. That money normally hits a trust account, and then we get the company, once the money's cleared, we then get the company to issue the share certificate or and the shares are issued basically. And then once the company has fulfilled the offer, then the offer closes, or it closes on the date that the company has nominated.
All right, we have another. So thanks, Bill. So
there's a question here: can an excluded offer be made to a limited 2012 offer? So the company can raise capital under the 2012 rule as long as that's a personal offer by the company. So theoretically, you can do those things together. The main thing is you can't have two different offers in the market. So it's illegal to, for example, have, say, two convertible note issues or two investment documents in the market or different offers, because that's misleading investors. So one of the main things is that you cannot mislead or entice investors. So, but you can go to your own personal network as well as going to sophisticated only. But from our side, we so we would work with the company around how to do those things to make sure that we're compliant and we're protecting the directors.
You got on their discovery meeting, and I really enjoy those. So that's a situation where at the beginning of the process, we have the company owners, founders, and maybe some of their exec team meet our entire team, give us a brief on their business, and brief the team, and then we on a whiteboard put up all the potential people that we could go to. So that's sort of in addition to the database that we have of around 25,000 sophisticated investors. So we literally come up with another bespoke list of where we can take the matter. Importantly, at that time, those founders and company executives can also tell us where they perhaps don't want to go from a confidentiality point of view. So I find it a really good meeting. Okay, Chris has asked, where do you see investor appetite at present for capital raising, and which sectors are on the nose?
I'm not sure any particular sector's on the nose, but I think just around that, I think the main thing is that the company's got to be able to scale, and the valuations are going to be fair. So I'll talk about valuations in a minute. But obviously there's some sectors that are hotter than others. But my advice for capital raising, or people that are raising, is if you're not in the market, you're not in the market. So you have to be in the market. So it doesn't really matter which sectors are going better than others. If you're not in the market, you're not there. So it's about strategically identifying what investors would fit the matter the best and go to those guys. So I think I'd turn it around the other way.
Okay, we have a lot of companies that come to us that aren't investor ready. So this is a really critical piece. Do you want to take us through that, Mark?
Yeah. So essentially what we're trying to do here is essentially you've got to assume that the investors are looking at a number of deals at any particular time, and you want to stand out in that market. You also want to make it clear and simple for the investor to understand. And essentially we've got a methodology around the level of transparency and disclosure, I guess, we'd like to see. And then we can have a robust chat with the investors around the company. But essentially what it involves is putting a forecast together, a financial forecast with good assumptions, and we then generally test those assumptions. We, as part of that then we like to put an execution roadmap together, which I'll talk about in a minute, and that allows us to have a plan. So a lot of people would come to us and say, okay, I'm raising $2 million, I'm worth $10 million, and go find me the money, right? And so the issue is there is no silver bullet. You've got to put the work in, you've got to have a plan, you've got to have a business strategy, you've got to have tied to good use of funds, and then that's also tied to company valuation. You also have to have good governance and have the right team around you, and we find that's important as well.
Okay, so Bill's, what's your view of the role of safe notes?
Yeah, so that's a investment type, just like there's a range of different strategies around raising. So there's straight equity, which is just issuing shares for money. A safe note is an instrument where you're issuing future shares for money at an agreed or to be agreed price in the future. And then there's convertible notes. So from our side, we would generally raise. We would generally go into the market with a valuation that's known, so the investors know what they're getting. But there's a place for all of those instruments, and we would normally just say be flexible around those rather than pushing one or the other. And I think that sort of depends on the investor a little bit. So in terms of strategy, we find this very useful in terms of execution, and I've just put a bit of a roadmap here. So we normally do this with a company, and it sort of gets tied to use of funds. So what we're doing here is tying the use of funds to milestones in different timeframes. So what it's doing is getting you from the current state to the future state, and basically breaking that down into programs of work. To do that work, you need resources, which is basically people and money. And if you can enunciate that, then we can tie that to use of funds, milestones that are going to be achieved by deploying the investor's money or cash flows from the business. And then we link that to a demonstrated return on investment for the investor. So again, if you use my example, if we're raising $2 million, we can tell the investor when we're going to use that money, what we're going to use it for, and what we're going to achieve by using it in a simple way. And then we can follow the progress of the company quite easily by putting these sort of tools together.
Okay.
I just also wanted to touch on valuations because we see a lot of people coming to us with really high vals. And as people might be aware, valuations have really dropped, particularly in the tech sector in the last 6 to 12 months. And we know a lot of the venture firms that aren't investing at the moment because, the vals are too high. So essentially, the difference between your balance sheet and the valuation is really goodwill. So, and the investors sort of got to jump over that gap, however big it is. So, for a standard business, you would calculate your sustainable earnings. There'd be a standard multiple in the market that equals your business value. Then you have to subtract any debt, and that gives you your equity value. So essentially, that's a typical way to value a company. And we have obviously other measures that we can look at in terms of valuations.
And then how do you value the companies that are in really early stage?
Yeah, so essentially what we do is we surround a valuation using different methods. So there'll be a discounted cash flow. There would be this sort of calculation. We would look at multiples of other similar businesses in the market, whether they be listed or private companies or recent sales. And then because we do this all the time, we've got a pretty good view of what the current market valuation is for different businesses. And then one of the main things is that we can defend the valuation to the investor. So, what we're looking for, I guess, is being fair to the investor around the valuation. And so it's also fair to the existing shareholders as well. One of the things we wanted to talk about now is just common mistakes in capital raising. And we see that we've done this over the year, quite a few years, and we've seen a lot of businesses, and we've seen a lot of what not to do. But one of the things I'll point out is companies generally don't know enough about their competitors. So quite often when a company comes to us and they're raising capital, they'll say, we've got a new product, or they're in a certain geography, and we might have seen other businesses in different geographies or with similar products elsewhere. The other thing is we generally see that companies talk too much about the product. So really, when we're putting investment thesis together to the investors, it's around the investment opportunity, not necessarily around the product. So the product's got to work, and we've got to have expansion plans and be able to execute. But quite often we see people talk too much about the product and not enough about the investment opportunity.
And then I think sort of lately we're sort of seeing people almost come to us a bit too late, maybe particularly with debt matters. A comment around that?
Oh, I think, we see a range of matters, but certainly it takes time to get capital. And so one of the things is you've got to be investor ready, as we've talked about before, and then the valuation's got to be fair. And if you've got to raise capital essentially before you run out of cash, obviously. So if you're running out of runway, the sooner you can start taking action, the better, rather than leaving it till being too late, because then it gets hard to raise the capital, and you're in worse shape than we were before. So there's a timing issue as well.
Yeah.
So Greg's asked a question here about how do you look at a valuation when a company has no revenue. So it sort of gets back to quite often a biotech company or a mining company, for example, that's just got tenements, may not be in revenue, but you can still value it. So there's other methodologies for valuing companies that aren't in revenue, but it sort of gets back to the IP, how much have they spent? Again, similar metrics. And then obviously there's the discounted cash flow once they do get into revenue, and then you've got to discount it back to present value. So again, it gets back to experience a little bit around some of those matters, and and then it also gets back to a little bit how much money has the founders put in.
Okay, thanks. Now we'll have a look at some of the companies that we've raised for in the past. I've got another question here. So, Bill, again, what credence do you place on a business having contracts in place that deliver a sustainable and guaranteed revenue, e.g. 5-year plus 5-year renewable?
Yeah, obviously any offtake or customer agreements are, really help with being able to fund the business, but again, it gets back to all the things we've just talked about. So that's just part of the consideration around the business. In terms of clients, we've worked with many folk over the years, and this is just a smattering of different logos of different companies we work for, but essentially we've worked across a range of industries, different business models, different applications. We've done some quite technical matters, robotics, financial services, all sorts of things, and we've just got that experience, I guess, is what we're trying to leave you with.
And these are a few testimonials from some of the companies clients that we've had in the past.
Yeah, I've got a few different ones here. So in terms of capital raising, Instant Consult, people may have heard of that brand. That's a doctor's platform. We were able to get a strategic investor into that, and and then now moved to acquiring some of the other shareholders. So that was more of that again was a software platform, and we helped close some initial investment in a strategic investor. Newstra was a acquisition, and that just happened to be a debt funding piece on that side. But quite often, what we will do on an acquisition is debt funded, and then go get equity capital and to fix up the balance sheet if needed. Screen Coach was a really early stage software matter, and we got an angel investor into that actually helped not only bring the money, but also with the software development and testing. And then the other one on there, ADK Rural, they were sort of an import, sort of a design, manufacture, import business. And so really, in terms of capital, they didn't really fit the venture capital mold. And so we were able to get them some trade finance and other facilities to help them move forward.
And Keith, again, do investors investing in these unlisted companies typically look for capital growth of their investment over the long term, or a dividend income stream, or both?
Yeah, so typically we would have a range of matters on our books at any one time, and we like to have high yielding matters. Generally, they would be later stage companies or funds that are yielding. Generally, in this space, in terms of growth capital, generally the investors looking to make a return on their money, not necessarily dividends. So they're looking for the companies to grow, increase the valuation, and then get to an exit. So generally, the investors are looking for growth, capital growth, not necessarily dividends.
Okay, well, thank you. That's the end of the formal part of the webinar. I'll just open the floor now to anyone that's got any other questions from what they've heard.
You can just unmute.
And yeah, I'll oh, yeah. What was it? So you can now unmute if you want to just ask a question directly online.
Well, thanks, guys. Yeah, I'd like to ask a question. I'm just sort of curious as to your sort of view on debt and how much you're sort of seeing that's coming into the play in terms of, you know, how people, is it got more of a view from companies that are raising money? Is it a specific time in their raise they're looking? Are they, I mean, obviously they've got to have revenue to raise debt, but are you seeing any changes in debt as to how it's viewed by people generally across the market? Are people raising more? Are they raising less? Those sort of things. Just that generic sort of landscape of debt compared to equity at the moment.
Sure. So I think just a general comment, we're doing a lot more debt than we were previously. And one of the things we're doing there is bridging to the equity. So it takes, as I said, it takes time to get equity. And in the current market where the stock market is not performing, or people are a bit unsettled about the stock market, it then takes longer to raise equity capital. So what we're finding is we're bridging with debt to build out that runway. And so we're doing a lot more venture debt deals. We just did one out of Hong Kong the other day for an Australian company. As I mentioned, we would also generally, if we're doing acquisitions, we'll do it with debt, and then we go get the equity. So you can run them in parallel, but the debt informs the equity and the equity informs the debt. The issue on the debt side at the moment is because interest rates have risen, there's more risk in that market. And so, we're seeing, if you like, and this is probably a few months back, where the debt providers weren't sure about what to charge around rates because their cost of capital was going up as well. So you're seeing a bit of a double whammy there. As I also mentioned, because the values were high, particularly in the tech sector, we were seeing some of the venture guys withdrawing, and rather than investing equity, they would invest, from a venture debt point of view. So it's sort of a bit of both. I guess from a issuer point of view, you've just got to be open to your options around how to move forward. And then the issue with a lot of debt is it's asset backed. And so if you don't have the assets, then you're really going to struggle. And so the only other thing you've got then is cash flow. And then if you don't have cash flow or assets, then you have to go equity, if you know what I mean. So, and then once we get some equity, then you might be able to get some debt. So as I said, the debt informs the equity and the equity informs the debt. But, it would depend on each company's situation on the options that might be available. And then quite often we're able to do like a convertible note, which, is a quasi-equity instrument, but it looks like debt to start off with, right? So, that's another option. Hopefully that gives you some colour, Greg.
Yeah, it does. Thank you. And just sort of to follow on from that, and sort of what size deals are you sort of seeing at the moment that you're doing?
So essentially, as Ken mentioned, under the funding strategies brand, we just sort of do $500,000 to $3 million.
Okay.
And under the Bluemount brand, we do $5 million plus. So, so the larger deals would be a Bluemount deal, and a smaller deal would be a funding strategies deal. But we can do the whole gamut, if you like. And we're also doing cross-border and offshore funding. So for the bigger deals. So it just sort of gets back again to the situation of the company and the best options, to move forward. And then it's more likely that the company will get funded if all the things that we just talked about are done and they're investor ready and they've got good governance and they've got a forecast and they're hitting their numbers and all the stuff we just talked about.
Okay, Keith's come back around the safe notes. Are they structured more like a futures contract or an options contract?
Well, it's more like a futures. So basically, you're agreeing to the equity. Basically, it's a discount to the equity round in the future. So people are putting their money in, assuming that the next round is going to be higher than, that there's going to be growth in the company essentially. But you're kicking the can down the road in terms of the valuation at the moment. So you're relying on a future round to sort out the val. So they're just a different instrument.
Any more questions? Okay.
I didn't grab your details in the beginning, guys. I'm potentially coming up to Brisbane. It might be worth popping in and saying hello.
Okay.
Yeah, that's great. Okay, terrific.
Yeah, so our details are there, correct?
Yeah, I missed the first few minutes. Sorry, I was a little late.
No, you're right. But it should be on the invite that you've got anyway to join.
Okay, no, that's great. I can grab that.
Yeah, so just let us know when you're coming up, and we'll lock something in.
Yep, sounds good. We'll do.
Okay.
All right. Any other questions? If not, okay. Well, thanks again for joining us. We have recorded this session, and we will be sending you a copy of the recording if you want to go back over something. But again, thanks for being with us today. Hope to catch up soon. Thank you.
Thank you.
Thanks, gents. Appreciate it. Cheers.
Just go to the chat.